Okay. Hello, everyone. So today we are presenting on this weathering a commodities storm. So I'm presenting the true influences of gold and platinum price indices. Basically, I'm looking at the South African macroeconomic factors that impacting, and also gonna cover some other countries, how it is had impacted or how academic or literature has shown it. So mainly I'm presenting my presentation divided in 3 sections. First, I'm talking about the introduction, giving some project value chain, typical gold flow sheet, and some mineral economics discussion, and then project sensitivity. And then on gold and platinum side, I'm giving some historical context, a little bit of essay mining and finance, because my initial thesis was on South African context. So gonna give a little bit on that one. And then the commodity price, exchange rate, interest rate, main macroeconomic variable. And then some conclusion that I have drawn from the research work that I have done. So now coming to the typical mining project value chain, it's basically start with the mining and then processing plant and then inventory at mine house or at mining site, and then goes to rail and then port and ship, and then ultimately it goes to the market. But our precious metal value chain is a little bit different. From miners and recyclers goes to refiner, then goes to the mint, and then transport, also brokers, depository bank, and retail investors. So this is a bit different because there's no port or rail or those kind of transportation arrangement, but rest is pretty much similar to the other commodities. Now, because I'm talking on the gold and platinum, so just thought to also give you a brief background of the gold, typical gold flow sheet, basically. So typical gold flow sheet includes the primary crusher, secondary crusher, some grinding, ball mill, rod mill, or sag mill, and then carbon in leach, CIL, and then elution column, and then electrowinning and gold room, and finally gold bullion comes out and then goes to the vault or wherever it has to go. Now talking a little bit on the mineral economics factors. So basically what we normally a design house do, they do a mining project or look for any particular project and their economics, which basically consist of probably many projects of any mining companies, and then many companies consist or accumulated together become metal index, and then all those indexes are becoming part of macroeconomics. So in my research work, what I have looked at is basically microeconomic variable and its impact on all these three. Basically metal indices, but I've also looked at the factor on mining companies and mining projects. Now coming back to the starting with the mining project. So it is one of the requirement for an I-43-101 Canadian guideline that we have to put a sensitivity analysis of a project with commodity price, grade, capital, and operating costs. So as you can see from the graph, the gold price is actually influencing the most of the gold project. So if gold price increased from whatever base price you have taken to 20%, the economics of project almost like from 300 million to become more than 500 million. So this is the most influential factor for any gold project. And second important factor is the operating cost. As you can see, 20% drop in operating cost can have a quite significant jump in from base price to the actual project economics. And other factors, capital cost and exchange rate, they are factors. Sometimes clients complain about the capital cost, that project cost is too high, we have to bring it down. But as you can see from the project economics, it's actually least influential on the project economics. Now, another factor is discount rate, which is basically related with the interest rate of the country, and also how you fund the money or how you source your funding. So discount rate is basically exponentially related with the NPV of a project. So as discount rate increases, the project economics becoming bad and bad. So the increasing interest environment is probably not good for the project. Now coming back to the discount rate, giving a little bit more what it consists of. So discount rate basically is what we call in finance terms a weighted average cost of capital, consists of cost of equity and cost of debt. and then weight of equity and weight of debt, and then also some tax rate plays an important role here as well. So this way, I mean, we get some equity finance, some debt finance, and obviously there's some benefit of getting debt finance, but that again, when the interest rate increase, that can become sometimes a trouble for the companies. Now looking at the interest rate, as you can see, the equity risk premium, which is an important factor determining for the discount rate of the project, is significantly depend on the countries. And as you see, for a project in Canada and Australia, which has less risk, the discount rate is quite lower, or discount rate risk premium is quite lower compared to South Africa. So South Africa project has to be really lucrative in order to compete with an Australian and Canadian project for the same benefit. So it has to be giving better return. Now coming back to the South African mining in context, so in 1902, Sir Ernest Oppenheimer came to South Africa, and that is where the South African mining started. So he basically got he has to purchase a land holding for a group of German investors, and he saw there is opportunity and also acquired a land there. And then in 1940, World War I breaks, and Germans were worried about their security of their investment in British colony, and as a result, they wanted to pull out. And in 1917, Anglo-American was born, where basically Sir Ernest Oppenheimer pulled all his money and some family money, and some money came from JP Morgan, New York Bank, and Newmont Mining, and then Anglo-American Corporation was formed. Now, as easily accessible ores becomes difficult or exhausted in South Africa, it's becoming very difficult for syndicates to finance the mines. As a result, they started looking for finance to somewhere else. And they started going to London for finance. And as a result, Goldfields South Africa was one of the first companies probably formed in 1887 to acquire finance from London Stock Exchange. And now the question comes, why London Stock Exchange? Why not Johannesburg Stock Exchange? As you can see from the graph, the pot in London Stock Exchange is much bigger compared to what is in Johannesburg Stock Exchange, and which is basically, you see on the supply side, there is more money and more capital available in London versus in South Africa. And same thing for the demand side, there is a more risk appetite for investors in London versus in South Africa. Now coming back to the gold and platinum price determinant and commodity cycles. So there's a two explanation for any commodity prices. One is supply side explanation, another one is the demand side explanation. On supply side, the extension of the Hotelling model, which is basically a beach model, which says that if there are two suppliers of ice cream in a beach and the customer are in the middle, then the chances of each supplier will get equal number of customers. But if one supplier have decided to move closer to the customer, he will start eventually getting more of customer, the others start getting less customer. As a result, the other supplier will also force to move closer to the customer. And same thing happened with the commodity price as well. So when one commodity price increases, the people start jumping into new project that keep on bringing the new project. Eventually, the price also comes to an equilibrium, which is probably less than the highest price at which the project was started. On the demand side, there's the increased growth of in global demand recently from China and India, which has basically resulted in more demand for the commodity. As a result, the commodity price will keep on increasing. And there's also in academic literature mention of financialization of commodity, which basically says that some of the companies or finance houses basically buy the commodity futures, and that creates a false demand in the market. People in the expectation that the future is selling at a higher price, so it means the future demand is coming, and they keep on building a new project, but it was actually a false demand. So that is also one thing which complicates the matter. Another thing is easy monetary policy, which makes lending of money easily, and as a result, also sometimes the price goes up and down. There's a very nice book which I have read recently, give also some context of financialization of commodity market. Somebody interested can also read it. Now coming back to the demand and supply shocks. Okay, so what the academic literature says that the demand shocks, if the demand is there in the market, it takes 15 years to come the price to an equilibrium, while on the supply side, it usually only 5 years. So most of the supply shock or the price which has increased because of supply, the other suppliers catch up in 5 years and then prices stabilizes. The gold is a bit tricky because the central bank gold in jewelry can enter on supply side or demand side. So it basically makes it a little bit difficult to understand the price of gold. And gold is also considered as a safe haven when all the commodity or financial asset drops, gold price increases. You can also see from the graph when in 2020, all the financial assets started collapsing, the gold started going up. Now looking at the commodity price or gold price especially, and its impact on the gold producing companies. So North American firms in general, it has found that 1% change in gold price results in 2% stock moves. And Australian firms on weekly basis is 0.7% for 1% change in gold price, but in monthly basis is for every 1% change in gold price, their stock price increased by 1%. So Australian mining firms is average sensitivity of Australian gold firms are actually equal to 1. Now coming to the South African context, because platinum is the most important metal that we produce in South Africa, and 75% of world annual platinum basically come from South Africa, and 95% of global proven reserves are in South Africa. So volatility of South African macroeconomic environment have actually direct impact on the supply and the price of platinum. And as it is the most important commodity and probably get impacted, and also the macroeconomic environment get impacted, so platinum prices have a significant influence on South African exchange rate. But the appreciation of rand increases the direct dollar value of production cost, while the cost of commodity remains same. As a result, dollar returns decreases when the rand appreciates. Okay. Thank you. Let's talk about the exchange rate now. On exchange rate, these are some of the main important factors that affect the South African exchange rate: the GDP per capita, trade openness, fiscal balance, extent of foreign assets, and commodity prices. Now, commodity exporting countries, the commodity prices are actually a very important variable for explaining their real exchange rate. As you can see from Colombian peso, for Colombia, oil is their main commodity that they export, and actually that is their main export. So any change in oil price, Brent crude oil price, have direct impact on exchange rate of Colombian peso. So as the oil price decrease, the exchange rate also behave in the same way. So basically currencies start depreciating. Same thing for the Zambian kwacha, because for Zambia, copper is the main commodity that they export, or that is the main product that they export. So any appreciation in copper price basically increase or appreciates Zambian kwacha. But in 2020, some funny thing happened. Copper prices was going up, but Zambian kwacha wasn't going the same direction. So any academic work or any research work that has to be done they must look carefully at the 2020 data. Now looking at the exchange rate and stock market returns, so what research has shown that 1% appreciation in commodity price generally results in 0.5% appreciation in real exchange rate for commodity exporting countries. And resource stock tends to perform better when the currency depreciate, as we have explained earlier, that any appreciation in currency cause them their cost of production to go higher, while their commodity price that they're selling is fixed. For other countries also, for other countries also, like S&P 500 stock return and Bangladesh, India, Pakistan, and Sri Lanka, some have positive relationship, some have negative relationship, but in predominantly there's a negative relationship exists between exchange rate and stock prices across all the studies. Now coming back to the platinum price and SA exchange rates, there's a positive relationship between commodity price and exchange rate I have discussed earlier. Some studies have found long-run relationship, and some studies have found short-run relationship for commodity and exchange rate. But there is very limited study available for South African exchange rate and the platinum price. So probably this study that I have conducted is probably the first one, which has shown that there's a short-term grandeur causality running from platinum prices to the exchange rate. So basically, it's saying that there's some relationship with exchange rate and platinum prices for South Africa. Now coming to the interest rate. So interest rate, before going to the interest rate, why interest rate is important is also better to understand for the mining companies, because the main feature of mining companies are they have high fixed costs, they're capital intensive, and mostly debt finance. And mostly, and another thing is most of the commodity producing companies are price taker. They don't have any control on price of the commodity. Rather, it has been set by the market and they have to just take that price. So they have limited control to hedge or formulate any strategy to mitigate those. So yeah, therefore, interest rate, that's why becoming an important factor because of debt finance and capital intensity. So I thought it was also interesting to see those aspects. Now coming back to the interest rate, when I started looking at that, what I have found that interest rate sensitivity of equities are generally linked to the financial institution, as you would have probably seen now from last week. It's all over in the news that Silicon Valley Bank collapsed because of the interest rate hike by federal bank. They have put lots of money in the fixed deposit of long-term federal bond, and now they put it when the interest rate was 1%. Now the federal has raised to 4.74%. So all their investments are becoming actually less valuable than it was. So now people want their money back so that they can invest in somewhere where they can get a better return, and ultimately the bank collapse. But then that also makes me worried what will happen to the mining companies. So there's a good news. There's no worry for mining and metal companies. This data is coming from February. I think, yeah, February, where Professor Ashwat Damodaran has looked at for all industry, and he was looking for debt load, and what he have found, actually the mining and metal industry is least debt funded at the moment, and they have a very good interest coverage ratio, which basically says that the capital they are generating, that is more than enough for them to meet their interest liability. So mining and metal industries are safe even if the interest rate goes further up. So in conclusion, so what will have its impacts on the stock market return? So volatility in short-term interest rate is most important macroeconomic variable for all share index for South African market. And also, I think South African Reserve Bank use more often short-term interest rate to adjust the macroeconomic variable in South Africa. But there's a negative relation between stock prices and interest rates. As the interest rate goes up, the stock price goes down. Obviously, because of discount rate, you have to discount those cash flow, and obviously it will reduce the value of the company. Okay, so in conclusion, what I have done with my study, I have looked at the primary question: what is the effect of commodity price on JSE listed gold and platinum mining indices? And then some of the other questions that I have answered in my research was which factor most significantly influenced the commodity stock, spot price, exchange rate, interest rate, and market returns? And what is the influence of gold and platinum prices on the currency exchange rate? What is the influence of gold and price on the interest rates? So what I have found, I have summarized it. It was a long study and very technical in details and lots of econometric modeling, but I have tried to simplify it to make it easy for everyone. And what my study has shown that gold price index returns are related to the gold government bond rate as the primary variable, and the secondary two other variables are all share index and gold price. And for the platinum price index, again, the government bond rate, platinum price, and all share index returns are in that order. But interesting in my study, what I found is that exchange rate in government bond rates saves the movement in the platinum price. So any impact on macroeconomic environment of South Africa will impact in a negative or positive way for the platinum price. And that's it. Thank you very much for your attention.